Hey guys, I basically wanted to find some evidence to show you guys that dividends are a major contributor into the total performance um, of the S&P, and this was looks like this was Hartford Funds. I have no idea who the hell these guys are, but it says dividends have played a significant role in the returns investors have received during the past 50 years. Going back to 1960, 69% um, of the total return of the S&P 500 index can be attributed to reinvesting dividends and the power of compounding, as illustrated in Figure 1. And this is, say you invested $10,000 and, well, I don't even think the S&P, I don't know when the uh, S&P 500 index became into existence. I think it was actually later than the 60s. I think it was in the 80s that Vanguard came about. But anyway, just say you invested in the 500 biggest companies in America back in the 60s and you put $10,000 and you reinvested the dividends. If you didn't reinvest the dividends and just use that money to live on, you would have that 10,000 would turn into 600,000 over the course of 62 years, looks like. But if you had reinvested those dividends, it'd be $4 million. Looking at the average stock performance over a longer time frame provides a more granular perspective. From 1930 to 2022, dividend income contribution to the total return of the S&P 500 index averaged 41%. Looking at the S&P 500 index performance on a decade by decade basis shows how dividends contribution varied greatly from decade to decade. Um, I don't know why this has a NA. I guess this was like the .com bubble. But in the 40s, 67%. In the 50s, 30%. In the 60s, 44%. 73% in the 70s, 28%, 16% in the 90s, in the teens, 17%, and 23% 2020. But as you can see, here's, a 10% return here. I mean, some years was 20 and some years was lower. But I mean, if you buy the S&P 500 index today, you're basically getting, I believe, less than 2%. But I mean, it was as high as 6% in the 80s. So we're still kind of expensive. I don't know if you guys know what quintiles are, but it's basically if you like list all 500 companies in a row, a quintile would be like the say I don't know, the bottom five stocks or something might be the lowest quintile, and then the next or the next or the bottom 10 stocks or 20 stocks, and then the next 10 or 20 higher than that could be another quintile. I don't really know the purpose of this thing. It's just saying that the compound annual growth percentage for U.S. stocks by dividend yield quintile by decade. So I guess out of 500 companies, they just split it into 5 groups. Since there's 500 companies, I guess they did the bottom 100, the next 100, the next 100, the next 100, next 100. Well, this is interesting. We're talking about the payer ratios. Like I said, a lot of these bigger companies, they're paying 70% or more payout ratio. Now, in the case of utilities or REITs by law have to pay 90% of their income to investors, but in exchange for that, we got to pay some of the taxes. But it says the first quintile stocks at an average dividend payout ratio of 74%, while the second quintile had an average payout ratio of 40%. So if a company, let's say a company pays 70% of their profits out in dividends, yeah, they could keep paying for, several more years, but at some point, now, good companies like Coca-Cola and stuff, they can just simply raise their prices, but not all companies can do that. And so, if you can just rate, now we're paying $2 sometimes for just a little 16-ounce Mountain Dew. Whereas before, you used to be able to buy a whole 2 liter for 60 cents, which is a lot more, volume. But hey, people are willing to pay it for convenience or it says a payout ratio of 74% could be difficult to sustain if a company experiences a drop in earnings. A company could be forced to cut its dividend. So, if you're investing for the long run, I think it's better to invest in the companies with the lower payout ratio, like the ones that I picked for I think they're called dividend challengers, the one that have increased for 5 to 9 years. They're basically paying out 20%, 27%, 30%, somewhere in there, 20 to 30% of their earnings. So they have a long runway ahead of them. But, if you're paying 70% or more of your earnings out, that's very little money left to reinvest in the business, expand, to build new plants, to hire more workers, etc., etc. Whereas if you're only paying 30 or 40% out in dividends, you can steadily increase your dividends for probably the next 40 years, at least 20 years until you get up to here. And like I said, the problem I see with old companies is they eventually, just like people, get old and die. So I mean, granted, Coca-Cola's been around for 100 years. It'll probably be around for another 100, but there's not that many great businesses around the world. And usually technology will make businesses obsolete at some point in the future. I mean, Kodak basically killed itself when it invented whatever camera they they invented, but it basically killed them. I mean, they're back from the dead now a little bit, but they're still pretty much dead. Um, I'm just reading this. This is just talking about the volatility. Um, I mean, as an investor, like, you want volatility. A lot of people don't want volatility. They're scared and um, scared of losing money, but as an investor, you love volatility. Why? Because when there's volatility, that creates opportunities, that there's a mismatch between what the true value of the business is worth versus what the stock market is telling you that it's worth. And there was what's called efficient market theory or whatever that was preached for a long time, that basically whatever the price of the stock was, that's what the value was. Now, in some cases, in a lot of cases, that might be accurate at that one point in time, but there is always in the market opportunities that there's a drastic difference between what a company is actually worth versus what the stock price is. So all this beta and bullshit, like, it really don't mean nothing. Like, you want volatility. You don't want you want the volatility because you can buy things cheaper at a lower price when the market is mispricing the security. If you know what the security is worth, if you know Bank of America is really worth $20 and it's selling for 10, you might buy it at 10. But when it's selling at 30, and if you know the value of Bank of America is only $20 a share and it's selling for 30, then you don't buy it, and you might even consider selling it. I mean, in the long run, I think, Bank of America is one of the biggest banks. The reason Buffett owns so much of it is when the bank bailouts happened, he basically bailed the bank out himself, and because of that, he got these premium shares that he was getting 10% dividends, whereas the average person was only getting maybe 3%. He's getting 10%. Plus, not only that, but companies like Apple and Bank of America, they basically buy back their own shares. And Bank of America, a lot of times, was buying back 10% of their shares every year. What does that mean? That means that he was basically getting a 20% return on Bank of America, even if Bank of America never increases their earnings at all. He's getting a 10% dividend, and then not only that, he's also getting his ownership in the business is increasing 10% every year, basically because they're buying back shares. Um, Now, I think last year or whatever in Congress, these um, dum dums like um, what's her name, Warren or whatever, they put a tax on buybacks. So the government has decided to tax share buybacks. But as a investor, as a business owner, if you own a slice of the company, you are basically a part owner of the business. And if your stock is selling for $1, and you know as the business owner that your stock is really worth $10, yeah, you could pay a dividend. You could give some of that money back to the shareholders of your earnings. But what a smarter person would do would be to buy back your own stock. If you know it's worth 10 and it's selling for 1, you buy back your own shares. You decrease the amount of shares outstanding. Instead of 8 slices of pizza in the pizza pie, now you have 6 slices or 8 slices. So for every slice of every one stock or one share of the company that you own, you now have a bigger ownership in the company. And then the benefit is you basically put $0 into this. Your ownership in the business is going up, even though you put $0 into it. You're not. So that's why I like share buybacks. I mean, I love dividends, but when you see a company buying back shares, that's usually a good thing. Now, sometimes it's not a good thing. Now, in a case where it would be stupid to do so, let's say I believe the fair value of Coca-Cola might be $50 a share, or maybe even $40 a share. Let's say it goes to 100. Or 200 or 150. Now, it would be stupid to buy back your own shares at 200 or 150 if you know the actual value of the company is only worth $50 a share. So in that case, doing share buybacks is stupid. It would be better off to just pay the dividend out to people or maybe give them an extra dividend or whatever, as opposed to buying back their own shares. But if the stock is trading, let's say below book value or below what you believe the company is worth, buying back shares is a great idea, and it adds value to the shareholders. So this is saying that if you put $100 in 1973 and you only invest in the dividend growers and initiators, and up here it tells you what the dividend growers and initiators are. It says company that cut or eliminated their dividends, company that grew or initiated a dividend has experienced the highest returns relative to other stocks. So the dividend growers and initiators basically were the ones that were buying back their shares. They were the ones that were increasing their dividends every year. So the dividend growers and initiators basically gave the highest returns. The ones that either cut their dividends or didn't pay dividends or didn't change their dividend policy were the underperformances. But you know, this is where you want to be. You want to turn that $100 into $13,000. High levels of cash on corporate balance sheets. So if you got extra cash, you can either expanding the business or making acquisitions. You can buy, if you're a big company, you can buy smaller companies. That is what Apple has done. That's one reason Apple has been so profitable. Is any kind of competitor that came their way, they just basically acquired them or took them to court and made them bankrupt. But that's basically what a monopoly is, and technically, a monopoly is against the law. You know, when we had, you know, the modern day oil companies we have today was basically one oil company, and that oil company was split into 7. You know, it was split into Exxon, it was split into Mobil. Eventually, Exxon and Mobil merged, but you know, you had Texaco, we got BP, all, you know. And the same thing is true with the phone companies. The phone companies had a monopoly, and the government came in and split them up. And now we still got AT&T, we got Verizon, but you know, there was a lot more that don't exist anymore. There's a few other ones. I'm not sure of the exact history, but I just know 2 of them. 2 of maybe the 7 or whatever it was, you know, are AT&T and Verizon today. But there were a lot more of them. It says, while these options may be attractive in some environment, and the options are either expanding their business, you know, maybe building another factory or a bigger plant, hiring more workers, making acquisitions, buying smaller companies. During certain times, some corporations may be more cautious and choose to hold on to their cash in case of another economic downturn. Companies may also choose to use excess cash to initiate a dividend or increase their existing dividend payouts. You know, like a company like Microsoft, when Bill Gates started, he basically wanted enough cash to pay every employee for a full year. Now, there's not a lot of companies that can say that. And I think one reason Buffett likes, if you want 2 of the biggest companies that have the most cash, I mean, look at Berkshire Hathaway and look at Apple. I mean, I personally don't like Apple just because I think they are too heavily exposed to China, and I think China will copycat. I think they will steal their technology, and I think eventually will turn to their downfall. And I do not see them keeping a 30% of every single app on their phone forever. I think there's going to be, like I said, you know, in a competitive environment, growth has no value. And in the case of the auto industry, for example, when you had Ford basically a monopoly on the U.S. economy, all these other competitors from Europe and Japan and all over the world, Germany, came over and basically took away market share and kept coming until they had eroded all the profit margin. So let's say you have a profit margin of 30 or 40%. The competitors, and there's a low barriers to entry, they will keep coming and they will keep coming after you until your profit margins shrink to 10%, 15%, 20%. They're going to keep coming for you. They're not going to let you get a 40% profit margin. They're going to be coming for you because they want part of that market. They want part of that money. And I would say this: one of the companies I had invested in very early on in my investing career had something like a profit margin in the 90s. Their expenses were maybe 10%, and their profits were 90%. I mean, if you got a company that's making 90% profits, and I forgot the name of the company because later on I wanted to buy some more and I forgot the damn name of it. But it was a company that was basically making cream. It was a medical company, and I want to say they were making some kind of cream for I don't know if it was burns or something. They were making some kind of cream that healed people, and they were getting 90% profit margins. And anytime you have upwards of 40% profit margins, companies are going to keep coming for you until they can eat away some of that profit margin, so you're not getting 40% profit anymore. You might be getting a 15 or 20% profit. But yeah, I wish I could go back and look, because it's probably been 5 years now, and I don't know. Maybe I could have. Maybe that was a hunter bagger. I don't know, but it'd be interesting if I could find what that stock or security is worth today, and maybe it went bankrupt. I don't know. But it was one of these little over-the-counter, pink sheet things, penny stocks. But it would be interesting if I could find that one again. The average dividend payout rate is 56.3%. I don't claim to know what all these charts and stuff means. But in 1981, if you were in the corporate bond market, you were making almost 15% return, which is pretty good. And the reason I believe that stocks are always better than bonds is, like I said, a stock can basically, what a bond is you're basically getting just the whatever it says on the bond. And let's say you're getting 3%. Well, Coca-Cola can pay a 3% dividend, plus they might have an extra dollar per share that they're reinvesting in the business, so they're growing the business. They might be buying a new plant, or they might be going to a new market. Maybe they're going to India, maybe they're going to Africa, maybe they're going to South America, maybe they're going to South Korea or Japan. And so with a stock or a company, there's going to be some earnings that are always reinvested back into the company. So plus you're also getting capital appreciation. If you bought it Coca-Cola at $3 and now it's $60 or $70, you got the capital appreciation along the way. Not only that, but every year the dividend goes up. So today you might be getting a penny a quarter every 3 months, or twice a year, once a year, whatever. And then next year you might be getting 2 pennies, and the year after that you might be getting 3 pennies a share. So it always is going up. Whereas with a bond, you only can get that 3%. Now, granted, in bonds, it's an inverse relationship. You can also make money if the price goes up, but generally speaking, stocks will always outperform bonds, just simply because they can reinvest that capital back into the business. And it says institutional investors have gravitated to equity income mutual funds, while individual investors have fled them. And these are in billions. Dividends have historically played a significant role in total return, particularly when the average annual equity returns were lower than 10% during a decade. Now, I can guarantee you, de facto, if you invest in the S&P 500 index today at this current price, you will not get a 10% return. You probably will have a negative return. But over the long haul, you'll be okay. But in the short term, you might have some pain. But that said, that's still the best option for a know-nothing investor, is to buy the biggest 500 companies in America, or what this does not talk about is a lot of the total return is actually, you get basically world GDP growth for free, and world GDP growth has basically been at 5% historically. Well, not historically, but I mean in the last couple decades probably, it's probably been 5%, but now the world GDP growth is probably negative, or close to negative. And then you also get usually 2% inflation for free as well. Anyone that owns financial assets will, the 2% inflation every year historically, it does not affect people who own real estate or own stocks, but it does affect the people who do not own financial assets, and they just see their wealth every year. They're getting poorer and poorer and poorer. A dollar this year is only, the buying power is only 98 cents the year after, and then 96 cents the year after that, and 94 cents the year after that, and every year they just keep getting poorer and poorer. And in today's environment, like I said, the real inflation might be 20%, 25%. And so it's even more important today to be invested in financial assets, because if you're getting a hidden 25% hidden tax on the poor, which is basically what it is basically a tax on the poor. The poorest Americans are forced to pay more for groceries, for gas, commodities, food, rent, clothing. I mean, and then that leaves them little to no money left to invest. And then not only that, but you got the banks that are basically raping these people left, right, and center with these 20% or 30% credit cards. And people are just some people can't even make the minimum payment. And then you add student loans, you add credit cards, you add car payments and 2 or 3 cars. You add mortgages, and it's just an overwhelming burden that is putting a downward pressure on the economy. And it's hard to prosper and grow wealth when people are just so heavily weighed down by debt and they're in bondage. I thought we got rid of slavery, but I can tell you, slavery is alive and well today, and it has morphed into something called debt, and people are enslaved by this debt, and they can't get rid of it, and they can't ever get rich or have any sort of wealth, because they just keep getting more and more debt. They're broke, but they spend like they're drunken sailors. They spend like they're wealthy, and they live way beyond their means. That they can't afford it, but they can buy it anyway. They don't care, and that is not how you grow wealth. You have to get rid of your debt as fast as possible. You have to keep ahead of inflation, which is, like I said, historically 2%. So get better than 2%. I don't care if it's 3%. That's better than 2%. This temporary inflation we have now will disappear eventually. I don't know if this year, next year, the year after, but we already see deflation in China, which will lead here eventually. But so eventually we'll get the inflation thing under control. But I don't care if you just got it in treasuries. The S&P 500, just get your little 2% dividend yield, and you'll also get capital appreciation over time. Basically every 7 years you should double your money. At the very least, every 7 years you should double your money. So if you invest $10,000 a day, in 7 years you should have $20,000 without investing another penny. But because there's less one thing I will say about volatility, because these mega cap companies, these big companies, these quality companies, because there is less volatility, the chances of buying something at fair value or less than fair value are very few and far between. I haven't looked at Basically my thought is, anytime you see Berkshire Hathaway, for example, has over the course of history, there's been 4 times, or at least 2, that they were half off. They were trading at half of their assets, or the market overreacts sometimes. And let's say a company just released earnings and their earnings are down 14%, and let's just say it's not a long-term problem, it's just a short-term problem. Maybe they had too much inventory, and maybe they had to sell some items at a loss or at a very low profit, or whatever the reason. Let's say it's not a long-term problem, and the earnings for this quarter dropped 14%. And let's say people so in an efficient market, if the earnings of a company drop 14%, maybe the stock's down 14%. I don't know. But let's say the stock drops 50%, and let's say the earnings are only down 14%. I think that's an overreaction to a short-term problem that's not going to be a long-term problem. I will give an example of Papa John's. When the CEO, I don't know if he said a racist comment or something like that, and the stock probably dropped 50% or more, and that was just a short-term problem. The CEO was leaving. The business was still a good business. If anyone would have invested in, let's say, I can't remember the name of it, there was an electric company in California during the pandemic. There was all those wildfires, and they had all these lawsuits, and I want to say that stock probably went down 90%. If somebody could have seen, a couple years into the future, and seen that was just a short-term problem, it wasn't going to be a long-term problem, that they would have made a lot of money. And most investors today are short-term investors. They only hold a stock or a security sometimes for an hour or 30 minutes or 10 minutes and sell it. And instead of years out looking into the future, where most investors are looking out 6 months, and they might only hold a stock or security a couple months. You don't go buy a house and then next month, the price of it went up 2%, or the price went down 2%. I need to sell it. It's harder to buy and sell houses than it is stocks. It's easy to get in and get out, but the truly great investors will buy great businesses, and whenever they see an opportunity to purchase a great business at below fair price, they'll do good in the long run. They might have some short-term pain, but in the long run, they'll do okay. But anyway, thanks for watching, guys. This is a little bloated video, but I just basically wanted to show you that most of the returns of the S&P 500 have been dividends.